Welcome to Know What You Are Investing podcast. We decode the world's top companies. What they do, how they grow, why it matters. In this episode, we take a closer look at Salesforce's Q1 2025 financial results and FY26 strategy. Revenue grew 8% year over year, while cash flow remained strong and margins continued expanding. Behind the numbers, Salesforce is doubling down on AI, consumption-based growth, and a major data play with its planned Informatica acquisition. Let's dive into how this reshapes Salesforce's roadmap and what it means for long-term investors. Welcome to the Deep Dive. Today we're digging into the latest from, a giant in enterprise software, Salesforce.
That's right. We're looking at their Q1 performance and strategy, pulling from their official 10Q filing for the quarter ending April 30th, 2025.
And also from their Q1 fiscal 2026 earnings call transcript. Bit of a year mismatch there, but that's how the sources lay it out.
Yeah, it can be confusing, but the dates align. Our goal here is pretty straightforward. Cut through the jargon and pull out what really matters.
Exactly. Financials, big strategic bets, risks, basically where Salesforce stands right now. So let's get into it.
Okay, starting with the top line from the Q1 filing. Total revenue hit $9.83 billion.
Almost $10 billion. How's that compared to last year?
It's an 8% increase year over year. Solid growth, even if maybe not the explosive numbers they've posted sometimes in the past.
Right. And is that mostly subscription still?
Oh, absolutely. Subscription and support revenue was $9.3 billion. That's also up 8% year over year.
So that's what, like 95% of their total revenue?
Pretty much. The other slice, professional services, was actually down slightly, about 3%. Landing at $532 million. So yeah, the core software business is really carrying the load.
Makes sense. Now, alongside revenue growth, they've been talking a lot about efficiency, haven't they? Margins.
They have. They reiterated their guidance for the full year, aiming for a non-GAAP operating margin of 34% and GAAP at 21.6%.
Okay, 34% non-GAAP. That signals a continued focus on profitability, right? Not just growth.
Exactly. It's about profitable growth. Stripping out certain costs like stock-based comp gives a clearer view of the underlying operational efficiency, and they're clearly prioritizing that.
And did that translate into strong cash flow for the quarter?
It did. Cash from operations was $6.5 billion. That's up 4% year over year.
$6.5 billion in cash from ops. That's significant. And their cash pile overall?
Huge. They ended the quarter with $17.4 billion in cash, cash equivalents, and marketable securities.
$17.4 billion gives you options. What about expenses? Did those climb with revenue?
Yeah, some increases there. Cost of revenues went up, mostly employee costs and service delivery stuff, partially offset by lower amortization, though.
And operating expenses, like sales, marketing, R&D.
Those rose too. Again, employee costs, including stock comp, were a big driver, plus more spending on ads and professional services. And they also noted $36 million in restructuring charges this quarter. That's up from last year. It's tied to those workforce reductions and office space changes we've heard about.
Right, directly linked to that efficiency push.
Precisely. It all fits that narrative.
Okay, so generating strong cash, managing costs.
Yeah.
What are they doing with all that cash, specifically for shareholders?
Big focus on capital return. Share repurchases were substantial. They spent $2.633 billion buying back stock in Q1.
Over $2.6 billion. That's up from about $2.1 billion last year, isn't it?
It is a significant increase. It generally signals management thinks the stock's a good buy, and it returns cash to shareholders, potentially boosting EPS.
And dividends, too.
Yep. They paid out $406 million in dividends and equivalents this quarter, also up a bit from $388 million last year.
So buybacks and dividends, they're committed to returning capital.
Very much so. And what's interesting is how this connects to their big strategic move, the planned Informatica acquisition.
Ah, right. How does that fit in with the buybacks and dividends? Seems like a big cash outlay.
Well, they were quite clear on the earnings call. They expect the financing for Informatica to be non-dilutive, meaning they plan to use cash, tapping into that big reserve, and new debt rather than issuing lots of new stock.
So not watering down existing shareholders.
That's the plan. And crucially, they said this major acquisition isn't expected to disrupt their capital return program. The buybacks and dividends will continue.
Confidence or maybe clever use of their balance sheet and debt. It's definitely a balancing act investors will be watching.
Okay, let's pivot to that strategy. Informatica, AI, data, seems like that's the core focus now. Absolutely. The Informatica deal, assuming it gets regulatory approval, is slated to close early in fiscal 2027.
And the strategic logic. Why Informatica?
They're calling it a critical complementary asset. Basically, Informatica is a leader in data management, integration, governance, all the stuff you need under the hood to make AI really work effectively at scale. It's about building a stronger foundation for their data and AI ambitions.
Makes sense. You need clean, structured data for AI, and they expect it to pay off financially pretty quickly.
They do. The projection is for the deal to be accretive, meaning it adds to non-GAAP operating margin, non-GAAP EPS, and free cash flow by the second year after closing.
So adding to the bottom line, not just the top line.
That's the expectation. It's a bet that Informatica will boost profitability and cash flow per share relatively soon.
And this all plugs into their existing efforts, like Data Cloud and Agentforce.
Exactly. Data Cloud is scaling rapidly. They mentioned surpassing 22 trillion records managed. That's up a huge 175% year over year.
22 trillion, that's a mind-boggling number.
It really is. And it shows customers are centralizing vast amounts of data, which is, the fuel for AI.
Are customers buying into the combined Data Cloud and AI vision?
Seems like it. They said nearly 60% of their top 100 deals in Q1 included both Data Cloud and AI components. That's a strong sign.
Suggests it's not just experimental anymore.
Right. And half of the new Data Cloud bookings came from existing customers expanding their usage. That's always a good sign growing within the base.
Okay, and what about Agentforce? That's the more application-focused AI piece.
Yeah, think of it as AI agents for specific tasks. It's still new, only its second quarter, but they reported over 4,000 paid deals already.
4,000 deals already? That's fast adoption.
It is. Over 800 customers are using it in production. And about 30% of the Q1 bookings were from existing Agentforce customers adding more, consuming more.
So consumption is key there.
Definitely. And they're trying to make it easier with hundreds of pre-built templates for different industries and roles.
It feels like AI isn't just a product for customers, but something they expect to change their own operations to.
Absolutely. They explicitly mentioned potentially lowering sales and marketing costs as a percentage of revenue over time.
How?
By using more self-service, partner channels, and, crucially, using AI and agent tech internally to make their own sales teams more productive.
Interesting. Which ties into their whole go-to-market strategy, right?
Yeah.
Expansion and driving usage.
Precisely. They're pushing multiple levers, getting customers to use more services, expanding internationally and in the enterprise space, and building out more industry-specific solutions.
And hiring more salespeople to drive that?
A lot more. Account executive headcount is up 14% year over year now, and they plan to hit 19% growth by end of Q2 and 22% by year end.
Wow, that's aggressive hiring. Where are they focusing?
Mostly in lower cost regions, but specifically targeting areas they see as having higher potential for productivity and growth. Smart expansion, basically.
Did they call out any specific bright spots in terms of markets or industries?
Yeah, they mentioned small and mid-market business was doing really well humming, they said, with mid to high teens growth. Geographically, the UK, France, Canada, and parts of Asia Pacific, especially South Asia, saw strong new business. And industry-wise, comms and media and health and life sciences performed well.
And this shift towards a consumption model you mentioned earlier, how significant is that?
They described it as a new game. It's moving beyond just selling the subscription up front. The focus is increasingly on making sure customers use the services, especially things like Data Cloud and AI, after the sale, driving that ongoing consumption.
So value realization becomes critical.
Exactly. And it's changing how they even compensate their sales teams.
How so?
They've introduced a new metric, net new AOV, average order value. This measures both new business and renewal expansion performance together.
So reps are incentivized to grow the whole account over time, not just land the initial deal.
That's the idea. Focus on overall customer health, adoption, and expansion. It aligns incentives with that consumption model.
Okay, so that paints a picture of the strategy. Growth, AI, data, consumption. But every company faces risks. What do the filings highlight there?
Well, the usual suspect. Legal proceedings. They're involved in various lawsuits, including IP infringement claims. Litigation is always an uncertainty and a potential cost.
Anything specific jump out?
They did specifically mention the Slack litigation risk. These are claims, securities, class actions, and related suits that were filed against Slack before Salesforce bought them.
So Salesforce inherited that risk.
Essentially, yes. The filing notes they may ultimately be subject to liability or settlement costs from these pre-acquisition lawsuits. It's a lingering issue.
What about risks related to how customers use their platform?
That's another one. They highlighted the risk of being sued for actions taken by customers using Salesforce products. They mentioned past allegations involving Backpage as an example of this category. It's a tough challenge for any platform provider, potential liability or reputational damage from user actions.
And with all the focus on data and AI, privacy and regulations must be a big concern.
Huge. They slagged evolving data privacy laws globally, increasing restrictions on cross-border data transfers, things like that. Plus, industry-specific regulations, like in finance or healthcare, could limit how customers adopt cloud and AI, or just increase compliance headaches.
Being global also means dealing with trade issues, right?
Definitely. Governmental sanctions, export controls, these can hinder international competition and carry liability risks if not followed perfectly. Geopolitics and trade policy changes add to that uncertainty.
And finally, just general market risks. Currency, interest rates.
Yep, the standard exposures. Fluctuations in currencies like the euro, pound, yen against the dollar can impact results. Interest rate changes affect borrowing and potentially demand. They also noted that because revenue is recognized over time, a market downturn might not hit the P&L immediately, but it will affect future quarters as deals renew or new business slows.
Okay, so we've covered a lot. We've seen Salesforce posting steady, if not spectacular, growth in Q1, a real emphasis on operational efficiency and strong cash flow generation.
And a clear commitment to returning that cash via significant buybacks and growing dividends, even while planning the major Informatica acquisition.
And strategically, it's all about data and AI, right? Informatica is meant to bolster that alongside the growth in Data Cloud and the rapid uptake of Agentforce.
Plus that big push on expanding the Salesforce globally and shifting the whole company's mindset towards driving customer consumption, not just closing deals.
But balanced against that are these ongoing legal risks, like the inherited Slack litigation, potential liability from customer actions, and the ever-evolving landscape of data privacy and regulation, not to mention market volatility.
So pulling it all together for you, the listener, what's the core tension or the big question that emerges from all this?
Well, I think it comes down to this. Can Salesforce really pull off this acceleration? Can they successfully ramp up growth by investing so heavily in sales, in the Informatica integration, and these new AI products? Can they do all that while maintaining the strict financial discipline, the margin targets, the cash flow focus they've worked so hard to establish recently, especially with all those market and regulatory uncertainties swirling around? That feels like the tightrope they're walking right now.
Thanks for your listening Know What You Are Investing podcast. Decode the world's top companies. What they do, how they grow, why it matters. If you found this episode valuable, follow or share it with someone who wants to stay ahead in business and investing. Until next time.